Before we get into this next guest, we wanted to give a huge thank you to all of our guests, listeners, and advertisers for all of your support. Please spread the Built World love by leaving us a review, follow us on Instagram and LinkedIn, and subscribe to the show. We drop a new episode every Tuesday and plan to keep them coming. This next episode is brought to you by Büro, our title sponsor. With 8 vibrant locations in Miami's best neighborhoods, Büro is the perfect co-working place to work, network, and thrive alongside other entrepreneurs and creatives. Find your space at BüroMiami.com. Let's go. We are here, Büro Central Miami. We got the Brain Trust, Anthony Graziano, IRR.
Integral Realty Resources.
That's right. Juan from CoStar. Thanks for coming back.
Juan Arias.
Happy to be back.
These guys have joined. This is Juan's been with us a few times, and Anthony was one of our OG guests.
One of the early guests.
Yeah, one of the early guests.
Very happy to
and
be early. You've had a lot of great guests on since then. So
thank you, and we're excited to have you back on here.
Thanks. You told me you were going to bring me back. If I had any predictions, we were going to check on them.
Exactly.
So I did a little review on my podcast. We'll start out that way. I did a little review. I told you guys in the third quarter of 22 that we were going to be pencils down. I think that bore out.
Well, before we get started, can you give us a little background on who Integra is?
Wait. Before we get started at all, we need to start this off properly.
Yeah.
Cheers, guys.
Yeah, cheers.
Salute.
We got raspberry, some.
Yeah, we got a little medley. We got some double black, some Florida Cagna.
Yeah. Cheers, guys. Thanks for coming back.
Now, I'd like to also say for the record that, Joe Rogan just allows anything in his studio. It doesn't have to be something to drink. It could be something to smoke.
Hey. So what did you bring?
Let's see where this podcast really takes.
Spark up. We're here for it.
I love it. Cool. So welcome, gentlemen. So let's just start off real quick by giving a little background about IRR, Anthony.
Sure.
And then we can go into some of the predictions that you gave to us. This was almost 2 years ago, right? More than that, almost.
Third quarter of 22.
Yeah,
it was a while ago.
So welcome again.
Thank you. Thanks for having me back. Integral Realty Resources is a nationwide real estate valuation and consulting firm. We have about 525 employees around the U.S. and Caribbean, 55 offices, and specialize in real estate valuation and counseling advisory services.
So are you guys competitors here? Are we going head-to-head over here?
No, just the opposite. CoStar is a third-party service that we use regularly.
Awesome.
CoStar, has a variety of clients. Juan will tell you, but no, certainly in the valuation space, CoStar is,
heavily
relied upon.
So you guys use CoStar too?
Oh yeah. It's almost, you can't not use it, right?
Yeah.
Because otherwise your clients are looking at stuff that you don't see as quickly.
Well, they keep buying everybody.
Well, there's that too, right? Vendor consolidation.
Well, happy Liberation Day, guys.
Yeah.
Are we feeling liberated?
You guys are feeling free?
What did they say? Somebody told me this morning, they said, "Are you terrified?" I said, "No, it's perfect. I'm going on a podcast. They're going to steal that."
Shit. Well, cool. Lots to talk about today. Just with everything that's going on in the markets and with the tariffs. So before we get started, though, let's look back at our conversation from 2022. I think it was.
Oof.
Let's see if you made any right predictions. Any good calls?
All right. So there's 2 comments on my 2022 performance.
Okay.
I broke the whole thing down just to kind of see what we talked about.
That's awesome.
And I have to say, after 90 minutes, we really only spent about 10 minutes on the market, which was great, right? I mean, we talked about the Miami Hurricanes and Cocaine Cowboys. We talked about a little bit about Integra's origin story. We talked about my good friend Jack Winston and Mike Cannon. A whole bunch of things, what I read, what I did, girls in the Boy Scouts. I mean, we just went crazy. But what we did talk about back then, because the market was still running pretty hot, coming off of 21, 22, interest rates had just started to go up, was really what was the direction, where we were to go. And I said, interest rates are going to continue to go up. It's going to be more challenging, and we're going to go through a pencils down period, which we really did in 23. 23 was probably one of the more difficult years, particularly coming off 21 and 22.
Yeah.
So there was that. And then the reason that I brought this water gun with me today, I'm going to hand this to you guys. So in listening to the podcast, I don't know, I guess I had fundamentals on the mind at the time. I listened to 90-minute podcast. I must have said the word fundamental or fundamentals 50 times. So my daughter was getting ready for an oral presentation, and she kept saying, and I took a water gun, and every time she said, "Oh," I shot her with a water gun, and after about 2 or 3 runs through it, she got through the whole thing without a water gun. So I'd like to hand you guys this gun, and if I say the word fundamental, you have to shoot me.
Love it.
How's this thing? I'm gonna shoot Felipe.
Check it.
Yeah, because it.
Oh,
It's pretty serious, right?
oh yeah.
Love it.
Is it loaded?
No, it's well, it has some water in it. Maybe if you need to put more, you certainly can. I didn't want to ruin the equipment.
Locked and locked.
Yeah, I love it.
You can also fill it up with whiskey.
Yeah.
Ooh, we might have to do that. You think it measured out a shot with this thing?
Absolutely, that thing it's crazy.
I like that. All right, you might be getting capped here, so be careful.
The word fundamental is off limits.
All right, cool. All right, Juan, you're up next. Give us a little background about you and CoStar so our listeners know what's up.
Sure. So CoStar is a real estate data company. Basically, what we do is we aggregate data across all property types, and then we generate market reports, sub-market reports. And my role is basically I am the director of market analytics for the South Florida region. I write the market reports, the sub-market reports of the area, and I go out and I do presentations, a lot of speaking engagements, and I keep the region and the country aware of what's happening in South Florida in real estate.
So you're mostly focused on South Florida. Graz, you kind of have more of a national perspective on things just because your firm is doing not that CoStar isn't national either, but you're the CEO of the company. You're looking at things at a more scale at the national level, where Juan is more focused on South Florida, right, Juan?
Yeah.
Okay, cool. So lots to talk about. I think we start with Graz, right? Let's start with Graz. What's going on?
Oof. I think it's a perfect summarization of today, right?
Yeah, I mean, the markets are down.
Yeah.
We're in this tariff war. The 10-year is below 4%. I spoke to my cousin he's a banker in Switzerland, and he's like, "What the fuck is going on with the United States?" I'm like, nothing. I'm like, this is paradise right now. We're below the 4%. Like, this is perfect for real estate. But I think a lot of people are kind of like, around the world are like, they're losing their shit. And I think some people in the United States as well. A lot of people in the United States. So what's your sense overall with what's going on right now?
Sure. I mean, look, let's talk about market sentiment, right? We have a new, presidential election happens in November. A lot of momentum behind that, people betting on what does that mean? If we get a real estate president, is that going to be good for real estate? Is he a real estate president? He's a second-term president. Consistency was always an issue with him in the first term, what was going to happen. And of course, following the election and the confirmation that Trump was going to be president, there was an immediate sort of backlash from the other side saying, well, we're going to, anything he tries to do, we're going to try to frustrate, but he's got, the majority of the Congress behind him. And he comes out of the gate, gets inaugurated, comes out of the gate strong with all of his promises and just starts going at 1,000 miles an hour. I think right now the big concern is not what does the world think that the United States is doing, is more importantly, what from a policy perspective, do we have a cohesive policy that's predictable? And I think what's happening right now, both in the stock market and in the real estate market and in the economy generally, is that there's no level of predictability. It's sort of what could happen next is really dependent on the whims of what Trump decides he's going to push on. And some of the things that he's saying, I think, are not hitting well with economists. They're saying they're counteractive. These are, some of the things that he thinks are going to fix the economy in the long term are going to hurt the economy in the short term. Some of the things that folks counted on in terms of, interest rates are going to go lower and that's going to help moderate. Inflation's going to moderate. These things are happening sort of in countervailing forces, right? So you say, well, we want inflation to moderate, but we're going to surcharge tariffs, which is going to make things more expensive to consumers. Those are two competing ideas. What happens in the long term and the short term? So I think our biggest problem right now is there's a concern that there's no predictable, measurable, when is this going to, what's going to happen? And so the market is acting like it always does. It's behaving erratically.
I completely agree with that. I mean, if you look at economic policy uncertainty index, You can look it up on the Fred. Basically, it's at the highest levels it's been over the last decade or so, right? Because nobody knows what the next turn is going to be from this administration. So I think Liberation Day, kind of started us on this roller coaster that we're going to be in for the next few years. Now, the good thing is that we are coming off of a very, very healthy economy where we have an unemployment rate right now of 4.2%. If you look at the latest jobs report, it was above economists' expectations, 228,000 jobs added. And we've continued to see a decline in inflation. We've continued to see a surprisingly healthy consumer and strong import activity coming off of retailers that are trying to get ahead of these tariffs. So the economy is still really, really healthy. Now it's time to see, how much of a battering can it take. And that's basically what this administration is bringing to the table right now, is how much can I batter this economy right now, within an idea of, like he mentioned, basically, doing some long-term changes with, short-term pain.
Is it even more unpredictable than it was in 2020, that index?
So right now, if you look at the data, it is higher.
That's crazy.
Because it's specifically economic policy uncertainty.
Got it.
So
Right. Policy back then wasn't in question. It was just like
what's happening in general with, the pandemic, etc. Right now, it's just this uncertainty around tariffs.
Policy. Yeah.
Yeah. And
Here's the pandemic.
No.
There's no question. I think it's two different measures, right?
Of course.
But in terms of, what Juan is saying about, people's concerns and things about things that are happening, I think he's absolutely correct. I think the business community right now came into 25 saying, stay alive till 25. This is our year. We're going to rock and roll. We're going to come out of the gate strong. And we're sitting here in April, and it seems like we haven't come out of the gate yet, because there's been so much thrown in front of us that could really change, your investment thesis or where you're going with things.
Felipe, ever since we moved into Büro, my productivity has been through the roof. I mean, I might actually be getting things done for once.
The energy at Büro just makes work fun. Plus, with 8 locations across South Florida, from South Miami all the way to Hollywood, there's no excuse for not finding a spot to get your shit done, Ben.
And we're not alone. Over 500 local companies call Büro home. Everything from creative agencies and real estate firms to tech startups, law firms, and media companies. It's a melting pot of brilliant people, and we don't include ourselves in that category.
We definitely don't include ourselves in that category. Büro really has space for anyone, whether you're flying solo or have a team. There are suites starting at 100 square feet all the way up to 2,000 square feet. They also don't try to lock you into long-term agreements, and everything is month to month.
Let's not forget the important stuff either. The coffee is top tier, staff is incredible, and has a very entrepreneurial vibe. It's not just a workspace. It's a place where work actually gets done.
That's right, Ben. So if you want to level up your workday like we try to do every day, check out Büro. You might even catch us sipping some espressos between podcast sessions.
Or tequila.
Definitely tequila.
Tell Büro the Built World sent you, and you'll get 50% off your first month's membership. See you out there. Cheers.
Later.
But the rest of the world, of course, is freaking out, because this really does put the United States back in the driver's seat, and it puts them in a very awkward position. And what we are seeing, obviously, is businesses adjusting and starting to bring manufacturing back to the U.S., which is part of Trump's thinking, that this will bring business back to the U.S. We extend the tax cuts. That brings more businesses back to the U.S. for favorable tax rates. The big picture ideas behind what he's trying to accomplish are fine. The details are lacking. And that's part of what's creating, some of the shifting and uncertainty. And certainly in the stock market. Jobs the same way. I mean, you talk about the jobs report. I think everybody sort of woke up after, successive years of jobs reports about how great the economy was, and realized, wow, most of this was healthcare and government jobs that were created. And now Trump comes in and says, we're going to cut all these government jobs. That's going to be a massive reversal in the employment picture.
Yeah, I think the hit is expected to be around 0.4%. If, we do continue to see these layoffs take place, and that will take us up higher to around 4.6% unemployment. I mean, that's still below 5%, which is our natural rate of unemployment. So we're still at a very, very healthy economic environment, even with the federal job losses. I think going back to the uncertainty side, that's where we are more concerned just given the fact that, businesses have less of an idea whether or not, they're going to expand, whether or not they're going to hire. And the best hope we have right now is that, this Liberation Day, these tariffs are more of a negotiation tactic that's going to be a short-term play that hopefully does bring in players to the table to negotiate on trade. And what we saw today was basically Vietnam coming to the table and saying, hey, we're going to talk about this. We want to see if we reduce our tariffs and we can work this out. And Vietnam is a key player right now in terms of imports coming into the U.S. because after, Trump's first administration, we basically shifted supply chains partly to Mexico, but a big part also went to Southeast Asia where labor was still cheap, including Vietnam. Vietnam has been one of our biggest import partners over the last few years. So if we can figure out trade with them in a more normal manner, then that will begin to, provide more clarity as to what this was all about and where we're going to be heading over the next few years.
What do you think, Raz? You think Vietnam is the first shoe to drop in the negotiation here?
No, look, I think there's a couple of
the first domino to drop, right? Like, because
I think the threatening of tariffs even a month ago, Canada turned around and said, no, we'll do more. Mexico said, no, we'll do more. I mean, I think that the starting point of the negotiations was the threat of the tariffs. That was one. This implementation phase is now the retrade, right? Now it's set in stone, and now you know what you're negotiating from. But the bigger problem is the rest of the world is looking at us and saying, wait, we already had a deal with the U.S. that was just broken as a result of this retrade on the tariffs. So now we're going to sit down with the U.S. and do another deal that we're going to shake on? And what if they decide to change their mind? The difficulty with the cards that Trump is playing right now is that the other party on the other side is going to say, is this agreement going to hold, even if I come to a new agreement? So, whether it's Vietnam or whether it's Canada or Mexico or, our largest important trading partners, include Mexico, Canada, and Europe. I mean, I think Vietnam's important. I'm not saying it's not.
Yeah.
But certainly we've got to look to our allies and look them in the face and say, hey, we retraded you, but we didn't do it to hurt you. And I think that's going to be a hard story to tell in the next 6 months. This is going to really hurt Europe.
It's for your own good.
You take that story so far, see what it is. This is the United States flexing its muscle, and I don't think the rest of the world is going to take too well to it. And I think what we're also going to see is we're going to see rising nationalism in these countries where they're going to say, we're not going to buy American. We're seeing it in Canada.
Yeah.
Canada took all the American liquor.
It was already happening before this. And I think we got a first taste of what, the trade wars were going to do in his first term. And what basically came out of it was a reshuffling of trade activity to nearshoring. But then again, you look at who was investing in that nearshoring, and it was still China that was still coming into Mexico and creating manufacturing plants and then exporting that stuff as if it was coming out from Mexico.
Yeah, it was kind of the law of unintended consequences here, right? And so it seems like Trump was like, okay, I try to do this, but they almost outsmarted us. Mm-hmm. Now it's my turn to turn the screws a little bit because we can't have them do that again to us.
Right. So from my point of view, I think the hope is that this is a negotiating tactic to clean up some of the mess that was left over from the first time that we had this trade war. And hopefully it begins to fix kind of that continued dependency that we did not fix, that we still have on China. Even though coming out of, the 2016 period, that trade war, we reduced our dependency on China and we increased it significantly from Mexico. Once you clean up the numbers,
it's still China.
There's less of a certainty around that.
Yeah.
And bringing it to the impact on South Florida, I noticed in your presentation, you said tariffs on China, remain the key concern for South Florida's ports.
Right. So if you look at import activity through South Florida ports, basically we have a lot of trade with Latin America, but I think the number 2 country or big chunk of our imports, specifically container imports, are coming from China. So even though the amount of activity has come down from the levels that we saw prior to 2019, China is still a big trading partner with South Florida and with most of the ports.
I was going to say, I think that's probably predominant with most of the U.S.
Right,
ports.
right.
Which
Now
you're a longshoreman or you're tied to the logistics supply chain at the port. That has to be pretty scary right now because you're going to see a decline in throughput of TEUs just because the trade has to be affected, which is going to have a negative impact on that port real estate.
And you have further talks of implementing charges on Chinese ships docking on U.S. ports, charging a ship $1 million or $1.5 million to dock in a U.S. port if it comes from China. So that could further have a very significant impact on import activity. If you look at the National Retail Federation, what their estimates is by the summer of this year, imports are going to drop dramatically. We already went through all these retailers trying to get ahead of the tariffs. So that inventory, like stock building, is gone. And we have an environment where the tailwind for job growth has subsided. And all the tailwinds that we were getting on the consumer side have subsided as well. So there's no momentum really for more inventory, more imports coming in.
So we're going to start seeing more real estate trades or what?
How does this affect real estate?
So I think if you look at the industrial side, it's still very tight in terms of vacancy rates, right? Where you have some vacancy ticking up right now is in the older logistics facilities where new competition has come online in the last few years that has been, attracting tenants, right? Now you have brand new, shiny, 32-foot clear properties.
Giant properties.
Right, really nice. That have been offering incentives over the last year to attract these tenants because there's a lot of supply for big bulk logistics inventory, right? So I think the move from those older facilities into the newer ones is opening up opportunities on older locations. Now, whether that is I buy that older location, demolish it, that might be the case, and build a new industrial facility because that older location is going to be much better than where they're building all the new warehouses, which tend to be farther out, right? So if you are able to buy that, more infill, big warehouse space, and maybe you subdivide it, right? And you create kind of small bay warehouses, but brand new in infill locations, maybe you get more opportunity there, even with a further softening of industrial demand. But industrial is has been so attractive, and it's been coming off of such strong momentum that finding the buyers and the sellers that are willing to transact, that's going to be
I was going to say the sellers still have these really high expectations. So even for those old facilities, they want to see those higher per foot numbers, and the numbers really aren't there yet. They got to start feeling some pain, some vacancy, some prolonged mortgage and tax insurance payments over a longer period of time before they're like, all right, I'm ready to dump this thing.
Yeah.
And that's happening. And we saw a decline in the amount of spec building probably starting at the beginning of 22. The industrial guys were doing a lot of speculative where it wasn't built to suit. They were just sort of building a million square footer and waiting for someone to come along. That started to slow down in 22 and almost died entirely in 23. Interestingly, land prices have not come down. The land sellers are saying if you want it, you're going to pay for it. It's $1.5 million to $2 million an acre in South Florida. And they're not moving because they feel like the land God's not making any more. And so I'm going to sit here and wait until someone's going to pay me that number. That speaks to sometimes going into infill sites, although I would argue that a lot of the infill locations for industrial now are either being rezoned for higher and better uses, redevelopment into retail or multifamily. Some of the communities want the industrial uses out altogether, eliminate traffic, eliminate truck traffic, et cetera. And some of them, honestly, we've grown past and skipped over those industrial sections. And now they're industrial sections that are largely in the middle of residential and retail and office locations. So maybe they should be rezoned. But again, that's just putting more constraint on land availability, which is continuing to hold up everybody's expectation around land.
And warehousing availability.
And warehousing availability.
So that's the story of the last mile infill industrial segment over the last decade, right? There's inventory demolitions, right, that have continued to happen. And I think there's some areas like near the Miami airport where that's still going to be industrial, because the need to be close to that airport is going to trump, having more retail or more office or multifamily. So there's some areas that are going to be left here and there in the patches that will remain infill, high demand, increased prices. Maybe you have one of these facilities that has one big tenant that blows out or moves to a nicer space, and they have more challenging time over the next year because the tailwinds are softening. But that's a big maybe.
We're seeing this in New Jersey. If you go up and down the New Jersey Turnpike, if you have 800,000 to 1 million square feet, tenants all day long. If you need 100,000 to 300,000 feet, there's no tenants in that gap.
Mm-hmm.
And so these buildings that are 200,000 square foot buildings are being challenged, while yet the million square footers are getting leased up. I will say too, I mean, if you look at what's happened in the last 10 years in terms of what was really driving that demand, it was the last mile delivery-based systems, Amazons, the Walmarts, the Targets, et cetera. And a lot of that that infrastructure has now been built.
Yep.
So I think a lot of the run-up that we've seen it is now going to taper. And if you're buying industrial real estate today, and you love industrial real estate because it's been the darling of the real estate community for at least the last 5 years, be careful.
Yeah.
Understand what the core demand is and what the supply is, and be careful, because on a replacement cost basis, land costs are very high. So you can convince yourself, hey, I can pay $200 or $250 a foot because I can't get any land and this thing's already built. But at some point you have to be able to rent it feasibly. And that's where we're seeing the disconnect. The pricing right now is disconnected from the rental rates.
And I think it's important to note that, those tailwinds have shifted, right? The tailwind was e-commerce a few years ago because it was growing at 40% annually. Now the growth rate of e-commerce annually has dropped below even the pre-pandemic trend, right? So you've seen Amazon kind of slow down its absorption of space. They had 1 million square footer in Homestead that had pushed back the occupancy constantly. So that tailwind is gone. The consumer side of the equation slowing down, right? So all the other retailers are not going to be expanding their logistics right now because there's no real need to build up inventories. And you got to really, really focus on the fundamentals of your local market. And fundamentals.
I just said, do we get
I don't get shot.
You're down for one. We'll give them 5. We'll give them 5. All right, 5, and you can shoot them.
So
All right, we're locked and loaded here. Check the clip. All right, we're good.
If you look at the industrial employment sectors that have continued to grow, one of them, at least in South Florida, has been construction. So construction jobs are at the highest level they've been since like 2008. So that tells you, hey, demand's going to focus in on infill, small bay warehouses, iOS sites, things like that, right? Where you're catering to a different tenant base. You're no longer big e-commerce warehouses. You're now catering to the local demand drivers. And for South Florida, that is real estate construction that's kind of holding up right now because we had a pipeline of apartments that is still making its way through.
Ben, you know what they say in real estate, if people don't know you, they're not doing business with you.
Exactly. That's why the Built World podcast works with top of mind public relations, because being a best kept secret sure doesn't pay the bills.
Paula Uspa Abbott, the brains behind Top of Mind PR, is a former real estate journalist, so she knows exactly what makes the media pay attention.
And let's be real, getting in the press isn't just about bragging rights. It's about building credibility, landing deals, and making sure the right people know your name.
Whether it's top-tier media coverage, killer storytelling, or just making sure you're the one people think of first, Top of Mind PR has you covered.
Want to stand out? Hit up topofmind-pr.com or email info@topofmind-pr.com.
Because in real estate, if you're not visible, you're invisible.
And that's exactly what we're seeing on the front lines. Like, we've been focused on East Hialeah. There's a lot of demand to buy 10,000 to 30,000 square foot warehouses, but there's just no sellers.
Right.
And the small bays are getting obviously the premiums on rents. Everyone wants the small bay, but there's just not a lot of sellers. Everyone's pretty happy. So,
and if you're an owner user, which
where are you gonna go?
a lot of the small bay warehouses are owner users. You can't sell that warehouse because that's your livelihood. And the only, like, if you sell it, you're just going to move way, way farther away from your consumer base.
Right. And I want to go back to something else you guys both touched on, which is the land. These land sellers still have these really high expectations, but they're going to be stuck with it because you can't pencil anything right now other than luxury condos, which we kind of touched on. I mean, the yield on cost that equity markets are requiring is like a 7+. And even if the land is free in South Florida because of hurricane codes, you can't get to a 7 if you have to build structured parking. It's just not going to happen. So there's no new multifamily development really going on. Like there's really not much other than condos going up.
I will say though, I mean, I do think there's an elevated expectation from the developer's perspective, the yield on cost. You know, a couple of years ago it was probably 5 to 6%, and now everybody's saying I won't even move on anything unless it's 7%. And I think the developers live and die on this idea of yield on cost. But if you really sit them down,
it's not the developer; it's the equity markets.
Well,
it's the LPs that are demanding this.
Listen, money hasn't been a problem. Even in the last 2 years, getting capital to a project has not been the problem. That's what I was going to say. If you can try to look at it from the perspective, the developers are saying, hey, we want, or the equity says, I want a 7% yield on cost. Their problem is their problem has been managing the construction costs. They've been escalating so quickly that no matter what they pencil in their yield on cost, the slightest variation in the cost of materials, cost of labor, both of which have been rising 20-25% per year, destroys yield on cost. It just goes to zero. And then they go like, I don't know if I'm going to be able to build it for this much. I was watching, we were at an Urban Land Institute meeting a few weeks back, and we had 4 of the area's most prominent condo developers on this panel. And all of them said the same thing. They said, you know, we have to go for the top of the market because our construction costs are so unpredictable that we don't know if this is going to cost us $800 or $1,000 or $1,200 to build. I remember when I first got down here 14 or 15 years ago, you know, new condominium projects in downtown Miami were selling for $450 to $600 a square foot.
Yeah, 600 is expensive. Oh my God.
Today, that's a bargain. That's amazing.
Brickell City Center had inventory remaining in 2015-16 that they couldn't sell for $600 a square foot on the brand new project right in Brickell. So, but that was the old numbers downtown. It was like $450 to $600 a foot. And now all the developers are saying, we can't do anything for less than $1,000 a foot on cost, which means they have to be up over $1,500 or $1,600 to make the project even come close to penciling. And then they have to think about absorption and timing and inventory and all that. So I think this yield on cost thing is a factor that the equity markets are requiring a higher yield on cost, but that's not the reason the projects aren't penciling. The reason the projects aren't penciling is just the high degree of variability on costs. Now,
and that goes back, that goes back to how we started the conversation, like uncertainty, right?
Right.
And what do tariffs do? They bring more uncertainty to this whole construction cost equation. When you look also at, you know, the immigration policy and uncertainty around that, look at, you know, at least estimates out there of, you know, around 20% of the construction laborers are immigrants, right? So you hit that side of the equation and more uncertainty on that squeezes costs on that. So that the added uncertainty, markets, they don't like it. And you saw immediate after effects in the stock market, but it's the same thing for real estate. Real estate doesn't like uncertainty, and you're just adding to it, right?
And that's one thing I noticed in your presentation. You said international migration remains the main driver of population growth in South Florida.
Yeah. So, I mean, as it has been over the last decade or so, if you look at Miami-Dade specifically, most of our population growth is international net migration. A lot of it coming from Latin America. Lately, a lot of it coming from Europe as well. But if you look at not just South Florida, but if you look at the rest of the country, over 80% of the population growth that we got as of the latest census over the last year is international net migration.
And domestic is moving out of South Florida.
So, of South Florida specifically. But if you even look at generally Sunbelt markets, you have domestic out migration because they're getting more expensive.
Right.
And you get international migration that's replacing it, and some domestic immigration that is of higher income that is also replacing some domestic net out migration. But so far in South Florida, what we're seeing is that the domestic migration is net negative because the lower income households are way more abundant, and a lot of them are leaving, and they're getting replaced to a certain degree, but not fully, by higher income households moving in.
Which is making them more renters, is what I...
Part of the equation is some of them become renters. Some of them also move out to, Port St. Lucie has been... San Lucie area has seen some of the strongest population growth over the last few years, stemming from people from Miami leaving and going to that area. You also have population growth in central northern Florida, Georgia, Texas, the Carolinas. A lot of it coming from Florida because those are lower cost states to live in relative to South Florida. And that is not going to change. I think even though inflation is normalizing, there is nothing in the next few years or even in the current administration's policies that would indicate that prices are going to drop or contract significantly anywhere. Everything's going to just continue to get more expensive. And Miami is at a point where it's gotten so expensive that even to rent an apartment, you have to make at least $120,000 a year.
It's insane, but they're giving a lot of concessions now because there's a lot of his supply right now.
Yeah, so you've seen that increase in concessions, but still, I mean, you get a month, 2 months of free rent, but you still have to pay, $3,500 a month, $4,000 a month, and the typical salary, the typical household here makes it $80,000. So, there's a big discrepancy between, the supply that we built over the last few years and what's still in the pipeline and what the renter and the typical household in Miami can afford. And that discrepancy is going to stay with us for a while longer. The estimates from UF is basically we need 100,000 units of affordable housing by 2030, and we have 30,000, 40,000 units underway of luxury housing. Very out of whack with what we need. Now, there have been a few announcements of more affordable apartments getting built, following the Live Local Act and things like that. But if you look at the income requirements from that, you can be at 120% of AMI and still build it under Live Local. And
but even that's
expensive.
I mean, we're building a Live Local project right now. We're building 142 units. And we're at 110 AMIs. But even getting that built is tough to get to the yield on cost that the equity markets want to see, because even with, we're in an opportunity zone, so that helps lower the requirements a little bit. But you still need subsidy because you're still not going to hit that number. Even building as cheap as we can, as efficient as we can, not a true pedestal, just being as tight as we can be, we're still, it's pushing to get to those numbers that these equity markets want to see.
I think that's going to be part of the equation. Part of the equation is going to be we have to stop building structured parking done to every one of these units, right?
But here there's not enough land. Like, you can't get a site big enough.
That's the point. Like, the developers want to get rid of the parking ratios, and okay, sure, to a certain extent you can lower that, but keep in mind that South Florida does not have a public transport infrastructure advanced enough to really let people just, walk around. And even with the Bright Line, even with the expansion of the tree rail, it's not there. It's not there. You still need a car here, right?
You're preaching to the choir, baby. I've been saying that a long time, and the market demands it. But ultimately, if you need to provide the housing, then the housing costs continue to escalate. Then you have to say, well, do I get an apartment with 2 spaces? And if you want to be in an that's part of the affordability equation. When you have to build a 40,000 space or $80,000 worth of spaces onto each apartment, right, it's going to cost you more. And then you're comparing the cost of that apartment to other opportunities around the country.
Because a parking space is structured parking. You're looking at almost $30,000-$40,000
That's right.
per parking space.
Yeah.
So
a space and a half costs you $60,000. That's exactly right.
Yeah.
But I will say that there are Live Local, I think, is going to help tremendously. The other thing that's going to help is that I think the county's getting a lot more serious and aggressive about rebuilding some of the old housing stock, about unleashing some of the county land that can be used. Michael Swerdlow has a major project in Little River, over 5,500 units he's planning. His land cost is in at the right basis. He did a land lease with the county, and he's moving forward with a big project there that's going to tie to Tri-Row Station and have some of that infrastructure to allow for people to live without a car. And then ultimately, our big pressure point is that there's no more single family land left. right? So when you talk about, housing costs are not going to abate, part of that is when you're measuring the value of what's happening to the single family market, you say, well, I hope these housing costs go back down so I can build a house. No, they're not going to.
That's not going to happen.
That's not going to happen.
Yeah, like if you look at the number of jobs relative to new single-family housing permits that we've created over the last cycle, we have created in South Florida. And generally across the country, it's going to be kind of the same idea. But for South Florida, it's 4 new jobs relative to new single-family home permits. When you look at apartments, we're closer to 1 to 1. But we're so undersupplied in terms of single-family new homes. And when you look at listings, when you look at active listings for sale for homes, single-family homes broken down between $1 million plus or below $1 million. And basically, we have way fewer listings below $1 million relative to pre-pandemic levels today than $1 million plus. At $1 million plus, we have plenty of single-family homes for sale.
The problem is they're all only worth $500,000.
Yeah. And anything below $1 million, we have 30-40% fewer than what we have in 2019. So we have a shortage of existing single-family homes, a shortage of new single-family homes, and that's not going to change anytime soon because of what you mentioned. Basically, we don't have the land for it, and a typical household in South Florida cannot afford $1 million home. And when you add on, reassessment of taxes, you're paying a significant amount of your income on just being able to live in South Florida. And that is detrimental to our overall economy. Because if I have less income to pay on retail, on education, on all these other services that, generate, economic growth, and all I'm paying for is housing, then our economy just begins to stagnate.
So let's talk about demographics really quick.
Good, because they're not cool, I can tell you that. This is like the nerdiest conversation I've had all week. But I'm really enjoying it.
At least we're drinking for it.
Yeah, because, everyone, during the pandemic was like, rah, people are moving to Florida, especially South Florida. Demographics really drives everything. Are people going to continue moving here? Is that slowing down? We were talking earlier about, office demand, that no one's building office anymore. We haven't heard of any big new businesses moving to South Florida. What's your impression on the growth of South Florida? Is it going to continue? Is it slowing down? What do you think, Graz?
So I think a couple of things are happening. I think it's been slowing down because of the changes in the economy and people weren't making as big of moves in 23 and 24. I may have said in my last appearance on this podcast, the big game changer at the time when we were seeing all the domestic migration from New York and Chicago and everybody was coming down here post-COVID, the huge game changer at that time that everybody discounted, wasn't hearing anybody talk about, was remote school. Remote school allowed people to come down and bring their kids and they didn't have to worry about anything. And then they got there. So all of a sudden people came and they said, wow, this place is free and we're outside and we're having let's just move here. Florida has always, and South Florida in particular, has always suffered what I call the halfback problem, right? People come down from New Jersey and they get here and then they're here for a few years. And they go, wow, it's too hot in August. There's a ton of traffic. The cost of living isn't as cheap as I thought it was going to be. Because I will tell you, I came from the Northeast, right? And you think like, oh, I'm going to save on my income taxes. I don't have to pay state income tax if I move to Florida. It sounds like a great plan. What you weren't counting on is your homeowner's insurance, being 5X.
That basically eliminates that.
Your school costs, private school costs drive you up because your public schools aren't necessarily as robust. When you factor in all of the things, I would tell everybody outside of Florida, don't move to Florida because it's going to be cheaper. You're just paying for it in a different way. So a lot of people move here and they go, wow, it isn't cheaper. Okay, so that's one. And then they say, but I do love not living in the cold, so I'll go back to South Carolina or North Carolina, and they go halfway back. That's what we call them, the halfbacks.
All right, I'm hesitant to even share this next sponsor because honestly, it's going to make our competition even tougher. This is some real insider intel.
Yeah, if you're in commercial real estate and still buried in spreadsheets and busy work, listen up, because CRE Task Wizard is about to change your life. It changed ours.
This isn't some generic virtual assistant service. CRE Task Wizard was founded by former brokers Elijah and Kevin, so they actually get what brokers need.
Which is less admin, more deal making. Your teams handle research, data entry, listing management, lease abstracts, basically all the annoying stuff that eats up your day and nobody likes to do.
Imagine not having to update listings, dig through lease terms ever again. Even cold calling, you can focus on closing deals. They handle the rest.
And the best part, it's efficient, affordable, and built specifically for CRE brokers.
Want to reclaim your time and make more money? Go to CRETaskWizard.com and let the wizard work its magic.
Oh, yeah.
That said, however, we have seen some really good movements of companies that are coming down that are higher value companies. And I think the technology and infrastructure sector can not only afford to live here, but can really thrive here. I was at, eMerge was a week and a half ago, and then Israeli Tech Week was last week. And I went to an event at Israeli Tech Week, and there were, 200 people there talking about different businesses that they were starting, incubators, technology incubators, investors coming, offshoring of technology infrastructure and building, just tremendous amount of excitement. So I think people still really want to be here. It's just, are you in the kind of business that can afford to be here? And South Florida has always been challenged attracting the typical, Fortune 2000 corporate relocations. We've always been too expensive. We've always not had the right school system. We've always been challenged in terms of the cost of living and housing. But I think that we found our niche in terms of the people that can afford to be here. And of course, the people that are already here say, we don't want those hedge fund idiots or any of these other people to come down. But the reality is that money moves where people want to be, and the people that are coming with money are going to drive the cost up. And the people that are here are going to say, well, is it time to go? And that's that demographic change, that's renewing every city in the country.
So we were talking to Julie Medley yesterday from ULI.
Know her very well.
Yeah. And she had mentioned, what was the statistic that the two places in the world where there's the most amount of capital moving to are
Dubai and Miami.
Dubai and Miami.
Yes, true.
That's crazy.
Not even Palm Beach, huh?
No, it was South Florida.
South Florida,
South Florida, right?
So if you look at the IRS data,
I mean, this is globally. That's pretty crazy.
But if you look at the domestic, like IRS data, where most of the high net worth individuals moved was Palm Beach.
Yeah.
Second is Miami. So they're still in South Florida. So there's still a lot of wealth moving in. The thing right now is that we're transitioning from that moment in time where it was kind of a tailwind, where people were moving, it was easy, we were very affordable. Florida was so cheap. I grew up down here, right? Then I moved up to Boston, and never in my life did I really think I was gonna move back down here. But every now and then in Boston, I would look at like the nice condos I could get, on the beach in South Florida. I was looking at that and I'm like, this is so cheap. Like, why don't I move back? And then post-pandemic, everything got, the difference in pricing is almost negligible at this point, right? So the affordability side, it has also faded, right? So all those tailwinds are gone. And what you're seeing is the areas where you continue to see company relocations and tenant demand and office construction activity, Palm Beach. Why? Because there's an inorganic piece to it. You have Ross that is basically building his own city, and he's bringing in company relocations. He has 2 large towers that are currently underway, spec, and he's already pre-leased a piece of one of them.
And let's not discount the fact that he also pre-bought 80% of the existing inventory
Right.
before he even started. So
and
he
then
controls,
you look at
he has
the
a monopoly on 80%.
The one that just delivered that he owns, the one Flagler pre-leased, leased up relatively quickly and is full right now, right? So at very, very high rental rates. So I think the competition for all of these company relocations going forward is going to get trickier. Because if you look at the data of net firm migration over the last decade or so, Florida has been one of the strongest net gainers in company relocations relative to any other state in the country. And that will likely continue to be the case. The thing is that all of the metros, all of the big players, Tampa, Jacksonville, Orlando, all of the Tri-County region, they realize this, and they're all going to compete for these new HQs to move in, right? So it's not as easy anymore, and tailwinds have subsided. So I think going forward, our government officials, the private sector, have to be smarter about it, right? And they have to do a little bit more work in order to continue to attract these people. The other side of the equation is the demographic story, right? If you look at population growth, even though it's been, international, etc., if you look at the age components, most of the population growth in South Florida tends to be 65 plus. We have a very hard time, and generally in Florida, we have a very hard time in, continuing to retain households that are in their 20s and 30s. And that is, a big piece of working age population, a big piece of, the workers that these companies are going to need. So if you want a tech company to come here, or you want a big financial firm to come here, then you have to make it easier for younger households to live here and be able to work here. And at this point in time, we're not really making it easier, because if you're a younger household, your expectation will be, I'm going to marry, I'm going to have kids. And a big decision there, right, is once you decide to marry, then you become a homeowner. Then you buy a single family home. It's so expensive to buy one down here right
That's
now.
what we used to think. You might be getting old, I might have to say.
Well,
that's a very old school perspective.
It is, but it's still a big
It is.
piece
social,
of it, right?
I mean, if you look at the social chapter.
Right, and then the other side of it, even if you don't want to get married and have kids, right? We have limited jobs in the starting side of careers to build up individuals for a long-term career. So most of the company relocations that have come in, they've brought in executives that have already gone through a big piece of their career.
Yeah, I think I think that's, let me feel, I'm going to respond to this though, because this is an important point. I think you're right when you talk about a company like Citadel and they imported, their existing executives that they didn't have the talent pool here.
Yeah.
Okay. But I want to talk about the general workforce. I don't think the general workforce necessarily wants to leave. I think the problem is that the pay scale relative to the cost of living is so out of balance that the kids are saying, hey, I just graduated from medical school and I'm, a doctor now. I'm moving to Texas. I get all basically the same weather, but my cost of living is a third and my salary is about the same or maybe even 20% higher. And if I need to go out and find another job, there's plenty of these jobs here in Texas as there are in Florida. I think the problem with the 20 to 30-year-olds today is driving back to cost of living. But it is also tied to, companies being, that is the talent pool problem that we've always suffered, right? How do we hold the younger kids here and how do we pay them enough? And our pay rate in South Florida it's not there relative to what the cost of living is. Now, when people were remote and they were able to collect a New York salary but live in South Florida, it was no problem, right? You're collecting a Chicago salary, you're living in South Florida, no problem. But now that that's shifting back to, I'll say, a normalized level, the question is going to become is can businesses afford to pay the right amount of money relative to the cost of living? And that's where you start to have that tension, and the businesses say, well, I don't have the talent pool here, so I need to look elsewhere. And the people that are here saying, well, I am the talent pool and I'd rather live somewhere cheaper that's more reliable. And so these are the things that you go through. But I will say this, conversely, now let's talk about Florida at large. So Miami, Palm Beach becomes the most expensive place to live in Florida. Newsflash, it has been for 100 years, right? I mean, I don't know that there has been any other city in Florida that's ever been as expensive as South Florida to live in from the very beginning. That's just the way it is, But Tampa, Orlando have two really big things going for them, which is their proximity to Florida State University, University of Florida, and University of Central Florida. We've got our hidden gem of Florida International University here in Miami that's been a driver. The University of Miami, go Hurricanes, is a driver, although their undergraduate student population isn't large enough to make as big a difference. But what the Florida Legislature did 25 years ago in establishing Florida Prepaid and establishing Bright Futures is they let the kids go to school here because then they're likely to stay here. And what we're doing is we are retaining that younger talent. I just don't know that it's necessarily going to come back to South Florida, but I think as it relates to larger trends in Florida, Florida's still well positioned.
Yeah, no, and I think so another piece that Tampa and Orlando have is land, right? And there's the single family homes are have gotten more expensive, yet they're not as expensive as in South Florida, right? So that's a big piece of it. I think the schools piece of it is becoming a bigger issue, and it should be. I think FIU, are doing bigger pushes to create programs that are more attractive. But you also have, what is Ross doing in Palm Beach?
Vanderbilt, baby.
Brought in Vanderbilt, right? So they know that that is a very big piece of it, and having a big name is a big piece of it. So I think there's private entities that are very aware of the needs that we have. I think the legislature is also aware, but as is typically the case, the government tends to lag behind, right? So, for example, Live Local. A lot of projects have not broken ground through Live Local because there were issues on, building in the tax benefits into the underwriting and having actually getting the financing for that.
It's a real issue.
Right. So we need our legislature to make some changes there so that, you incentivize more Live Local, make the housing more affordable. The other piece of it is, there's this whole discourse about eliminating property taxes. Okay. Big question there as to, okay, if you eliminate property taxes in Florida, what are we substituting them with, right? Because you need the revenue to pay for, the locality, like all the government expenses at the local level and the schools, et cetera.
Just so we're clear, like
tariffs.
Yeah. Just so we're clear, like property taxes are paying for all your services. So your schools, fire, your local officials that are working in the county, in the cities, like that is what that revenue that is generated from property taxes pays for that. So you do away with that, you have to find another source of revenue.
Right.
So I'm not sure there's talk about increasing the sales tax. You're still going to have to pay for that regardless.
And who does that hit? So like you eliminate property taxes and you're benefiting older households who are homeowners, and the younger households who are not, they don't get that benefit. Now you've added taxes on the consumption side, which these kids are out there,
They're the ones that
consuming stuff as well. So you're hitting them more. So I think the conversation needs to shift towards, okay, can we gear, any tax benefit to incentivizing more of these young folks to be able to stay here, own a home, maybe they get a benefit on their first home, etc. These are, it could be anything, but I think the focus needs to be on this demographic story, which is a big concern. And going forward, if we continue, we're always going to be the land of the retirees. Like I don't think that's going to change.
What, Florida?
Yeah, Florida.
Thank you, Anthony.
I think that's been changing. I think it's completely different than the way it used to be. I mean, I think what the skyline looked like, it looked like in Fort Lauderdale in 1985.
I don't think Miami's the land of retirees.
No, I don't see it.
Yeah.
I mean, if you look at the growth by age group, most of the growth over the last few years, even coming out of the pandemic, is still in the 65 plus age group.
Yeah, but in fairness, that's the largest bulge of the population, right? That's your baby boomer. That's just the way the population's structured.
Right, but you look at any of the other age groups, and they've been flat to negative.
But their growth has been flat to negative. If you look at them across the country, forget about what's coming in or going out. I'm saying if you just look at a pyramid of population, right? 20 to 30 years.
So apart from the aging of America,
yep.
You add to that the fact that we are a big retirement destination, and we've always been, even though that could be partially changing over the last few years. We have a big disconnect of the demographics of our area relative to what we need going forward, given the fact that we continue to have retirement age individuals and fewer people in our workforce.
Ben, you and I are all about PropTech. And if there's one tool we absolutely cannot live without for our commercial real estate brokerage business at Gridline Properties, it's Vista.
Absolutely. Vista is incredible. We use it every single day. And we're always wondering, how do they do this? Every evening we get an email from them with real-time closed transactions. No more waiting around for months for the property appraiser to finally update.
Yeah, whether you're doing industrial, retail, office, land deals, They have every closed transaction. And it's not just the speed, Ben. The details are on point. Seller and buyer info, contact details, phone numbers, emails, everything is accurate.
It's hands down our top prospecting tool to farm for warehouse deals in Hialeah. Visda keeps us one step ahead always. It's also the best way to search for comps when putting together opinions of values for clients.
Head on over to Visda.com and use code BuiltWorld and get 30 days free access today. VIZZDA.com.
We need younger individuals to continue to contribute to our workforce in order for costs of labor to not significantly spike, costs of any services to significantly spike. As you mentioned earlier, doctors, maybe they move out of South Florida because it doesn't make sense to live here, right? So we need to make sure that we retain doctors because a big portion of our population needs those services, right?
I agree. I mean, look, I think when you talk about it conceptually, that's part of the decision that people make. But then there's the other element, which is people tend to want to be close to their family. So we talk about mobility, but the reality is only about 4 to 5% of the country is anywhere mobile without, outside of a 30 or 60-minute radius. We're not actually a very mobile society. We have the capability to be completely mobile. We can move from state to state. Our life doesn't change. It's not like being in Europe where I'm moving to a different country. I have to get work permits. But we don't really move. We say we move, but we don't. The retirees come down, but a lot of times they come down for 6 months, right? And they're here for 6 months and they're back somewhere else for 6 months. What I do want to say, in case maybe there's one or two politicians that listen to this podcast, and I think it's really important to say, is that if tomorrow you said we're going to eliminate real estate taxes, that's not going to change the cost for anybody. You know why? Because whatever you are paying in real estate taxes now is just going to get capitalized and added into the value, and everybody's going to be able to pay more, right? Your ability to buy a house or buy anything really is your occupancy cost. What does it cost me to service my mortgage? Plus, what do I have to pay for these other things? So when you say, hey, I qualify to pay $3,000 a month, you get $2,000 a month in principal, interest, and taxes, and then you have $1,000 a month for your homeowner's insurance and your real estate taxes. If you eliminate the real estate taxes, you can still pay $3,000 a month. So now you're going to either bid up the cost of that home, or you're going to go buy a bigger home because now you don't have to buy real estate taxes. And then everyone is going to do that, which means the cost of the home just went up. I remember when Kamala Harris was running around the country saying, we're going to give $25,000 to every first-time home buyer. I said, that's great. Well, then every first-time home buyer house is going to be $25,000 more expensive because everybody's going to be doing it.
Yep.
So this idea of creating these incentives or, say we're going to change this is, it's going to it's going to move downstream and get reabsorbed into the behavioral economic decision-making that happens. So I think
it's a great point.
It's actually better if we think of things like a pendulum, right? And if you take that pendulum back and you get an office and you pull that pendulum all the way back, it's going to swing all the way to the other side after you let it go. And really what the politicians should be doing is getting into office and trying to kind of just keep that pendulum swinging a little bit, but not too much, not too wide. Everybody's, my friends are freaking out about, what's happening in the Trump administration and the government and this. I said, guys, whatever they do, there will be a backlash, the same way this is a backlash from what has been done in the previous 4 years.
Yeah.
All of this is just sort of swings back and forth. And the goal really would be to let's have some stability. Let's not swing too much one way or the other, and let's everybody get stabilized and pay attention and do it.
So let's talk about stability because it seems like there's a lot of instability right now, and not just on tariffs, but like we were talking about earlier, like we have the cost of construction here is really affected by the tariffs and construction costs and labor, and a lot of these projects that particularly the high-end condos that seem to be penciling out, now it seems like there's going to probably be another pause here, right? Because we don't know what the cost of materials are going to be in the next 6 months until there's a little more clarity. How long do you think we're going to have a little more stabilization with an understanding of what the final result of all these tariff threats are that are happening right now? Do you think it's going to be 6 months, 3 months? You think there's going to be a little more clarity? What's that timeline, Anthony?
I think everybody's been pencils down for the past 24 months and they want to make a move. I think there's a pent-up demand for people to make a move and to get their project out of the ground or to get their deal done or to find a deal that makes sense.
But this issue with tariffs now is going to push those pencils. They're going to keep the pencils down, don't you think so, or not really?
I don't know. I think there's a lot of headlines right now.
Oh, yeah.
I think it'll get stabilized into the system over the next 3 to 6 months.
Okay.
And I think that's,
I like that.
it's going to affect the consumer a bit. And
Yeah.
that's certainly going to pinch the consumer. We always want to watch consumer demand and consumer spending because it's such a big part of our economic drive, of our GDP. But largely the real estate market is not, they're going to look at tariffs in terms of the cost of lumber and the cost of steel and things of that nature. But then other companies domestic companies are going to be able to produce that at a cost that makes sense without the tariffs. So we still have a U.S. manufacturing base for building materials. We build our concrete locally. In fact, South Florida is one of the biggest concrete manufacturers in the world.
Yeah. So if I think the news cycle has, kept people from looking at some of the most important headlines. And one of them has been, I mentioned earlier, 228,000 jobs added. The labor market's still solid. If you look at oil prices, in fact, if you look at WTI, it dropped to like $60 a barrel today because OPEC decided that they're going to supply the market with even more oil. So these things are, to a certain extent, deflationary. We'll see what happens. And then you have a labor market that's still really, really healthy. So tariffs are in play 100%, but we'll see what actually, gets done in a couple months because the administration hopefully is using it as a negotiating tactic.
And while that's happening, let me add, the supply of apartments in a lot of these major markets is now in the market. And so that's moderating rents, whether it's through concessions or even through reductions in the face rate. And the housing market has been slowing, inventory is building, so people are now re-benchmarking their prices. No need to panic. It's not 1986 or 87 or 90, 2005 and 6. But prices are moderating, or at least prices are stabilizing. On the single family side, interest rates are coming down, which will make it. But ultimately, the inflation, 40% of the inflation measure is the cost of housing.
Yeah.
So if that cost of housing stabilizes, that means that inflation is going to come down, which will give everybody a little bit of hope in terms of consumer confidence.
This is something that economists have been talking about for the last couple of years, that, look at home prices, look at shelter costs overall.
And they lag by 12 to 18.
Yeah, so they're coming down. Inflation will come down. Right now, the thing to watch right now is the labor market and consumers. If that continues to hold, then a lot of this tariff talk, whatever gets actually implemented, the U.S. economy is relatively good footing right now to absorb a lot of that. So I mentioned earlier, we're going to get battered, but we're in a good situation to take some punches.
I got battered. I had to replace the alternator on my Jeep this week. $800 for an alternator. I feel like an old man.
Jeeps.
No, I feel like an old man. It wasn't the Jeep. It was just the cost of the alternator, right? And it was like,
I love the fact that you drive a Jeep, by the way.
I did too, Jeep gang.
Yeah, baby. No, I couldn't believe it. Used to pay. This is what makes me feel like an old man, right? I remember paying $200 for an alternator. Now, I wasn't expecting it to be $200, but Jesus, $800. So, this is where we're going to, sort of get hit, where we're going to be like, wow, that's super expensive. But you know what? The U.S. consumer, for all the things that we malign, they don't have any discipline. They put everything on the credit cards. They never stop spending. They don't live within their means. They do adjust. The U.S. consumer does adjust. And I think we're going to see this period of adjustment where the U.S. consumer is going to pull back a bit. And then that's going to get everyone concerned because that's going to slow the economy. And then the feds are going to lower the rates. And then the feds are going to lower the rates, which will help with the housing market. And this whole thing stabilizes out. But as it relates to today's real estate investors, the question that they're asking is, where do I get my best yield, risk-adjusted yield? Where do I put my money today where I get the best risk-adjusted yield? And man, that's a hard question to answer.
Yeah, so
we covered that in Q3 of 22. And
That's what I wanted to do.
I want your predictions now, Anthony.
New construction development, it's not there right now. Right?
No.
Because of all of this added uncertainty, right? Not just on the side of construction costs, et cetera, but you're also seeing an economy that, yes, it's strong, but indicators are slowing down. So am I going to hit those rents, right? Am I going to continue to get that rent growth that will justify that, price point for development? And that added uncertainty overall, it's just slowing down development pipelines across the board. If you look at office construction, right? If you look at office construction in Miami and Broward County, there's almost really nothing going on in terms of new office development. The only one where you have new office development is Palm Beach, because Ross, inorganic, different story, right? So you look at office in Brickell, yes, run up in rents over the last few years. 830 Brickell hit almost $200 a square foot. That run up is muted right now. There's not much rent growth going on there. There's a slowdown in company relocations, et cetera, et cetera. So where you're seeing the investor tilt towards right now is, why would I break ground on a new office project if there's so much uncertainty around that right now? Why don't I try to buy an office property at a discount, right, relative to 2019 levels? And you're seeing some of those trades happen. So in Las Olas, 3 office properties in downtown Las Olas, 4 or 5 star, just traded at the beginning of this year. And you had some big trades as well in Brickell. The expectation being that there's no supply coming over the next few years. Supply and demand in the market. There's still companies here. And I can push rents on those current tenants. And any new tenant wanting to come down to South Florida will have very limited options here, right? So they're shifting around. It's not much development going on. You can acquire office assets at attractive price points. Medical office holding up a little bit better. But you know, the smart investor right now is looking at, where is the rent growth? Where is the rent growth? Small bay warehousing, if you can do it, that we had some of that, you know, mark to market in terms of rent growth. But generally, the lowest risk environment right now is where you can mark to market. Everything else in real estate right now, the risk is very elevated, unless you're on the debt side of the equation. A lot of money, a lot of that dry powder you were mentioning earlier, has been moving to the debt side, because you can get very attractive yields at almost no risk.
Have you guys noticed? I've noticed firsthand a plethora of hotels, specifically in Miami Beach, in the red, big time. I think there's 10 plus hotels for sale in South Beach right now. We're breaking the 300 per key floor that's been historical non-oceanfront independent properties. I think the rising interest rates, insurance costs, plus declining RevPAR since 2022 is kind of squeezing these operations out. Most operators are only doing about 20% net margins. And I'm seeing a ton of stuff that these guys are just trying to get rid of. I mean, it's a fire sale situation for a number of hotel properties in South Beach.
Yeah, but also add to that the complications of having to do their structural integrity reserves and capital reserves on these buildings that are 50, 60 years old that have historic designations. So you can't just say, well, I'll rip it down. Then compound onto that, you know, the rise in the really well-located, you know, high-end hotels that can compete and have some frictional costs that they can compete in the market and lower their rates, because they've created such a rate expansion now that they only have to chop their rates 20% to be at a feasible level. And all of a sudden, the sort of older hotels that aren't renovated, that are trying to compete at $300 a night, they lose market share.
What's going on, Builties? Ben and Felipe here. I wanted to cut in and tell you guys what we're working on. Believe it or not, podcasting is not our full-time gig. We're commercial brokers here at Gridline Properties, focused on industrial. And we've really identified the submarkets of East Hialeah, Opa-locka, and Golden Glades.
Yeah, we're big believers in those areas. The industrial warehouse space has grown tremendously in the last few years, particularly out west. The developers have been building product in the 100,000 square foot range. These areas, particularly Opa-locka, East Hialeah, and Golden Glades, have smaller warehouses, and we think those are going to do extremely well in the next 10, 20, 30 years. There's always going to be a need for small businesses and smaller spaces close to the urban cores, so we're extremely laser focused on these areas. So if you have a warehouse in the area or looking to buy or lease, or if we can help you lease or sell your property, reach out to us.
Yeah, we're just seeing a lot of value in that area. Everyone's getting priced out of Doral, getting priced out of Little River and Wynwood, and Hialeah is kind of the last frontier. And it's a wild west out there. So come on for a ride with us. Hit us up.
So there's a lot of competition, and then there's cost pressure, and then there's the other added pressure of it's not easy to redevelop. under the guidelines. So yes, there's a lot of these older boutique hotels that are too small for a major operator that are out there struggling to make margin. But also the numbers that they're paying in Miami Beach is some of the numbers have been overly elevated to begin with because
on the transactional side or the ADR side?
No, on the transactional side.
Sure.
On the transactional side.
But that's coming down. I mean, I'm seeing really interesting trades happening.
Of course. But it had to come down, right? Because
I think we had a few years where we had the domestic tourism, which drove a lot of the RevPAR growth.
2022 was like peak, and ever since then, it's been,
there was nowhere else to go.
Yeah.
Florida.
Yeah.
Right.
Yeah.
So obviously South Beach, everything was packed, and now what we're seeing is we're reverting back to pre-pandemic norms, which is a lot of international tourism driving this. And international tourism, if you look at visitor counts coming in through South Florida airports, it's just recovered to 2019 levels recently, right? And then domestic tourism has been flying internationally because they're going out to all these countries that were closed down during lockdowns, right?
Going to Italy in June, yeah.
Right.
Well,
And
the dollar's so strong too.
right. So
Compared to other
exactly,
currencies,
leave
so,
the country,
yeah.
go to Europe, go to Latin America, etc., and have a bigger vacation than you would have here.
Yeah.
So there's more competition, and the type of visitor is changing. And you look at the cost levels of South Florida today versus 2019, and for an international visitor from Latin America, where the economies aren't doing so hot, this has gotten way more expensive, right? So I cannot afford to go to that high-end South Beach location. Maybe I go to, nearby Sawgrass Mall. I do my shopping in Sawgrass Mall, and then I head out because I just came here, get my shopping done, and that's it. You're reverting back to the typical tourism that we used to have here. And then you add on spring breaker kind of restrictions that have been built in.
Restrictions. That's so kind, Juan. Crackdown. Down. This is not restrictions. This is crackdown. And look, I mean, I will say it. I'm going to say it to Miami Beach officials. Again, I get it.
Yeah.
You got to control. You don't want things to get out of control. I get it. But if you look at what Fort Lauderdale did in the 80s, like Fort Lauderdale had an amazing attraction. That was the place where the spring breakers went. They migrated up to Daytona after the 80s. They went to Daytona in the 90s.
Is this firsthand experience talking?
I don't know. This is like Cocaine Cowboys. Somebody told me. I heard it from something. No. But I mean, no, historically, firsthand experience. Yes, I lived through this, that Fort Lauderdale was the epicenter in the 80s of spring break. And they got to the point where they just couldn't deal with it anymore, and they shut it down. But it literally changed the character of what was Fort Lauderdale. Maybe, depending on your perspective, for the better. I mean, but it has consequences, I guess my point is, and people got frustrated and upset with where the direction, the safety of Miami Beach, and they demanded of their officials that we stop doing it this way. Tie that on top of that with Ultra and some of the other music festivals that were coming, and so everybody just said, we're not going to let things go hog wild. But then ultimately it came to the point where they tried to be incremental about it, and then they said, that's it. It's shut down. No more late night bars, no more public drunkenness, no more smoking weed in the street. And then everybody's like, well, this doesn't sound like a lot of fun. We're going to go elsewhere. So I think that's also a part, you talk about where is the demand for the secondary small boutique hotels, and then you eliminate a month and a half or 2 months worth of really high ADR because
The highest.
prices are coming.
Yeah, I mean, March is all time.
Average that into your pro forma, and
Yeah.
now you know why some of that's struggling, and that's just a consequence of like saying we're not going to do this anymore.
I'm just sniffing out opportunities. I mean, we got a bunch of rich guys moving here. The 10-year's coming down,
Yeah.
but everything's snafu, right? Situation normal, all fucked up.
Right.
So where do we buy stuff? Where's the opportunity in real estate? Like, where do we make some money here?
Yeah. Good question.
Yeah.
Question. You want me to just tell all the listeners on this podcast?
Tell us.
Millions of people.
Millions.
I think that
Let's hear your predictions, Anthony.
They want to know.
one of my predictions is that, and I said this, over the last 6 months to a number of private investors, the economy that we're in right now is going to be unpredictable in the next 12 months. And as a result of that, some people have been hanging on to try to wait for interest rates to come down and for them to be able to refinance their property.
Do you think interest rates are going to keep coming down?
I'm not a big fan of predicting interest rates, but I do think eventually the economy will dictate that the Fed has to make another move. I don't think they're going to come down as fast as everybody thinks they were going to. And I've been saying that for 2 years. And sure enough, it's been a lot slower than everybody was predicting. So I think it's going to be slowly and then all at once, because there will come a tipping point where you say the economy demands it. And then you're going to see that big 50 or 75 basis point drop. But they're going to go slower, and they're going to try to tell the market higher for longer until they can't. And then they were delayed in raising them to begin with. And I think they'll be delayed in slowing them more. But my main point is that there have been a lot of people that have been holding onto their real estate, not strategically defaulting, because they felt like, okay, it's going to get better. It's going to get better. It's going to get better. And they're going to need to make a move this year. So I think the place to find your best investments this year is to find the folks that can't hold on anymore. They need a recap.
What asset classes?
Across the board. But you have to decide what your risk tolerance is.
Yeah.
I said during the pandemic that this work from home thing was not going to last forever, maybe a couple years until the unemployment rate got back to 5 or 6%. And then everybody would demand that the workers come back to work. And that's where we're headed. We're headed towards 5, and everybody's saying, come back to work. Knock it off. We're not babies, let's come back to work. But if your risk tolerance and your operational excellence allows you to own an office building, that's going to be where you're going to get the biggest discount in most markets today. I really like retail today. And I like retail today because there are retail owners and operators that are generational, where your grandfather bought it and handed it down. And so there's 7 cousins that own this retail shopping center, and they all don't get along. And so they're going to want to get out. And if they're going to want to get out, now's a good time. Retail's pretty stable. It hasn't seen the run up in prices, kind of got re-benchmarked through COVID. So everybody the pricing in retail has been mitigated post-COVID. Consumer confidence is still good. So your retail tenants are still relatively strong if you're in the right location. If you have a great retail location, it's adaptable to any other use. So you buy retail, you got a lot of extra parking, you can convert it to medical office, you can add some. I'm seeing a lot of investors buying retail sites and getting them entitled with multifamily.
That's why Central City is one of the biggest examples there. You had an old retail strip center, and now they're adding multifamily on top of it.
I'm a huge fan of buying a retail shopping center for $10 million and then entitling it with an extra 200 units and adding $20 million worth of entitlements. That's a huge upside on the X, right? I think multifamily is risky right now. There's no multifamily. I don't want to say there's no. There are fewer multifamily value adds where I'm going to buy something and put 10 grand a unit and raise the rents $300 and all of that. But I am a fan of B apartments right now because the A market is so volatile in terms of their leasing and otherwise. But at some point, when your rents are $3,000 a month, and you own a B or a B minus that's charging $1,500 a month, you get a lot better rent elasticity to grow rents in that space.
Yeah, no, 100%. And the jump from B to A in Miami is one of the highest.
Right.
It's like number 12 or so in all of the metros in the country.
So your tenants are stickier?
Yeah, your tenants are stickier, but at the same time, you have very attractive brand new projects that are offering more and more concessions that are beginning to figure out how to take away tenants from the B. But it's still, that stickiness of that tenant base is going to be there. I mentioned earlier, we need 100,000 units of affordable apartments by 2030 in Miami-Dade. We're nowhere close to that target. And the demographics continue to indicate we need, most of our renters, 60% of them can only afford rents of less than $2,000 a month. And we're building at like 3,000 plus, right?
So even Live Local, like 120s, I think the 1 bedroom or studio is like 2,700. Yeah.
Right.
Yeah.
So there's a big mismatch still that's gonna be there for the longest time ever, right? So I think B apartments, if you can make it work, yeah, sure. Right now there isn't much rent growth going on in that segment of the market, or any apartment segment of the market, but in the long term, you are going to have more power to increase rents in that segment. Now, I think that the most important part of real estate is buying at a low basis.
That's why I brought up the hotels.
That's where you
Like let's offer some unreasonably low offers and see who needs to bite.
Right.
You know,
So From the office side, you had Columbus Center recently trade. It was distressed,
Really? I didn't know that.
right? So you have to look out for these distressed deals. That's where you're gonna get the opportunities right now to buy at a really low basis, decrease all of that risk.
Does
but you're
CoStar have a thing where we can see like who's eating the most shit or what? Like, is there?
For an extra charge, they
we have the CMBS data and IOLs and the ones that have shifted
Who's
to
delinquent?
exactly. So we have some of that info.
How about IRR? Do we have any products we can like see who's?
we don't like to do any competition with CoStar. That just breeds lawsuits that I don't need.
I don't know.
So we have we had talked to a lot of people that own real estate. We have a lot of confidential information about where people are when they're valued real estate. Oftentimes there's a purpose, whether it's their estate plan or whether it's their delinquency hearing for a CMBS or whatever. We don't sell that data because that would violate confidentiality entirely, but we do see in the market what's happening. And you know, echoing what Juan's saying, there's the CMBS distress rates have been coming up over the last, 6 to 12 months. The CMBS servicers are seeing more coming in, but most of that vintage is stuff that happened in 21, 22, where the basis was wrong, and then interest rates shifted against the interest rate caps, and so now the stuff's sort of jumping in, and the rates are still, 5 to 10% of the total CMBS that's out there, so it's elevated,
But relatively low.
I don't even want to say it's relatively high relative to historic averages, but the problem with buying a CMBS deal is scale. Right, you got to come in with, now you're coming in with hundreds of millions of dollars to try and, the CMBS world operates at a level that's 25 to 50 million plus on their loan side. So you're talking about much, much bigger loans. And you've got big players that have a lot of capital. They're going to come in there and be competing and know how to work through that system to get it out. And if you're a big time investor and you're, placing billions of dollars a year, maybe that's part of your thesis is to go after some of that distress in the CMBS market. I think this current market is going to be more about old fashioned digging, right? Like I drive around west of 826 all the time, not for any particular reason. I just like that area because it's not close to the water, which means it's not going to be subject to structural integrity reserves and flooding and all this other stuff. And I drive around there and I look at all this sort of vintage 50s and 60s multifamily, and I go, man, there's something here. There's something here that most people are missing because this is really where the people that work every day and get up and, this is where they live. I just think that looking for good opportunities is really about searching for the right locations, being where other people are not, communicating with the existing owners to understand their situation, because in any given market, in any given day, somebody's a seller. And it's just a matter of, who else has knocked on the door? Go where the competition isn't. Start knocking on the doors where people aren't getting a lot of activity, and you're going to find good real estate deals. And sometimes not today. Sometimes you're going to knock on that door. So, I'm not a seller. I'm not a seller. I'm not a seller. Well, here, take my number and call me back when you are. And then, 6 months later, grandma dies, they got to settle the estate and the kids don't have the money and they pick up the phone and they call you. So, when you talk about the big real estate investors, the guys that are big money, that's a different thesis. But for the majority of the real estate investors in the world that are in that, $5 to $25 million range, I think there's going to be a lot of opportunity out there in the next year or two because people aren't even playing in that sub $25 million game. There's not as much competition in that sub $25 million space.
And everyone's itching to trade. Like you said, it's been frozen for like 24 months.
It's been frozen and people haven't been able to make a move. Absolutely.
Yeah, we're itching to trade. Let's go.
Let's go. Let's do it.
I feel like with you guys here, we need to start a Built World Fund. I think we mentioned this last time, but like we're raising money. So if there's any LPs out there, let us know. Wire in a check. We got the investment committee here, Anthony and Juan.
My father and I used to drive around town and we'd look at it, we'd see a real estate deal or something and we'd say, this is what this should trade for. And then sure enough, within 6 months, something would happen. I'd say to him, damn it, we should have bought it. And he says, yeah. He says, only if we only had $48 for the down payment.
Oh, man. Well, Anthony, I'm a little disappointed you didn't say fundamentals. I was waiting to shoot the shit out of you a whole fucking time.
I was trying to make up. On average, between these two podcasts, I probably said it the right amount of time.
All right. Well, this has been amazing, you guys.
Yeah.
Thanks for joining us.
I think we're going to have to do this again. This was awesome.
Oh, yeah.
We learned so much today.
I wish you warned me how smart this guy was.
Yeah.
I thought he was just some talking head from CoStar who's going to come here with a bunch of statistics and basis point observations.
Yeah, we only bring top tier guests on the podcast.
I love it.
Let
Let me ask you a question. So the All In podcast, one of my favorite podcasts.
Oh, dude, yeah. I was going to mention that too. There's an amazing interview with the Treasury Secretary. Did you listen to that
I
one?
didn't see that one.
And what is it? It's Scott Besson, is that his name?
Yeah.
Yeah. Anyone that's listening to this podcast should listen to that one. It's an interview with All In. He did it a few weeks ago. I recommend that one.
I'm a couple weeks behind on my All In, but they have the besties, right? So I just need to know, like, what do you guys call your fans? What are your fans called?
They're called Bilties.
The Bilties.
Yeah.
Okay, I
Like Swifties, like Taylor Swift as a Swifties. We got the Bilties.
the Bilties. I love it.
I mean, we made it up, so they're stuck with it.
Hey, branding is branding, guys. You guys are doing an amazing job with this podcast. I'm so happy for you, and always happy to be here and make you feel important.
Awesome. Thanks, man. Seriously. All right. Thanks for making the podcast awesome today.
Absolutely. Thank you.
All right. Thanks, gentlemen.
Take care, guys.
Cheers.